Most traders enter a stock and watch it immediately move against them. Sound familiar? Before you place your next trade, pause. The market doesn't move randomly. It follows a deliberate campaign orchestrated by large institutional operators. Wyckoff cracked their code into 5 precise steps, from reading the market's trend, selecting stocks in harmony with it, measuring the cause built in a trading range, all the way to timing your entry. Follow this method, and you stop being the one they trade against. Every week, thousands of traders sit before their screens, scanning individual stocks with great enthusiasm, convinced they have found the next great opportunity. They study the earnings, examine the chart pattern, calculate their entry price, and commit their capital with full confidence. Then, almost without warning, the position moves violently against them. The stock they selected so carefully begins to collapse, not because their analysis of that stock was wrong, but because they committed the most fundamental error a trader can make. They read the stock before they read the market. Before you place a single order, before you study a single chart of an individual issue, stop yourself completely. Remove your attention from every stock on your watch list. Close those tabs. The individual stock is irrelevant until one question has been answered with absolute clarity. What is the general market doing right now, and where is it most likely headed next? Understand this principle as I understood it from years of observing the greatest operators of my era. The market is not a collection of independent stocks moving on their own individual merits. It is one living organism, directed largely by the campaigns of large institutional interests, what I call the composite man. When this composite man decides the time has come to mark prices upward, 3/4 or more of individual stocks will rise with him, regardless of their individual condition. When he decides to distribute and press prices downward, even the strongest-looking stocks will fall beneath his weight. In today's markets, this truth is more relevant than ever. Institutional funds, algorithmic programs, and hedge funds collectively move billions of dollars in coordinated waves. The retail trader who ignores this reality and focuses solely on an individual stock setup is, without knowing it, walking directly into the path of a force far greater than any single chart pattern can overcome. The correct method is to begin each analysis with the major market indices. In modern application, the S&P 500, the Nasdaq, or whichever index is most relevant to your universe of stocks. Study both bar charts and point and figure charts of these indices. Ask yourself, is the market in a trading range building a cause? Is it in markup, with demand clearly dominant? Or are signs of distribution appearing at the highs, warning that the composite man is quietly unloading? Only when this picture becomes clear do you earn the right to examine individual stocks. Once you have determined the market's position and probable future direction, everything changes. Suddenly, your stock selection becomes an act of precision rather than speculation. In an uptrend, you align yourself with the current of the river rather than fighting against it. Your entries carry the full weight of institutional momentum behind them. Your trades breathe easier, develop faster, and reach their objectives with far less anxiety. The market, properly read first, becomes your greatest ally, rather than the silent force that was quietly working against you all along. There is a particular kind of frustration that haunts the experienced trader almost more than the novice. The frustration of being right about the market's direction, right about the timing, and yet still watching a position slowly bleed against them. They identified the uptrend correctly. They confirmed institutional participation. They followed every rule they knew, and yet the stock they selected stubbornly refused to participate. It lagged, it stalled, it retreated while everything around it advanced. This is not bad luck. This is the consequence of selecting the wrong soldier for the right battle. Before you commit capital to any individual stock, regardless of how attractive its chart appears, pause your enthusiasm entirely. Ask yourself one penetrating question that most retail traders never think to ask. Is this stock actually stronger than the market in an uptrend or weaker than the market in a downtrend? Not roughly, not approximately, measurably, demonstrably, and consistently so across multiple rallies and reactions. Until you can answer that question with evidence rather than opinion, no entry is justified. The principle here is one I observed repeatedly across decades of studying the campaigns of large operators. The composite man does not distribute his buying power equally across all stocks. He concentrates his accumulation in those issues that respond most powerfully to demand, stocks that advance more than the index during rallies and surrender far less ground during reactions. These are the stocks carrying the greatest institutional sponsorship, the greatest internal strength, and consequently the greatest probability of producing a profitable trade. In modern markets, this selection discipline translates directly into comparative strength analysis. When the S&P 500 rallies 2%, your candidate's stock should be advancing 3 or 4%. When the index pulls back 1% in a normal reaction, your stock should be holding firm, giving back a fraction of that decline or barely moving at all. This behavior, observed consistently across multiple swings, reveals the presence of large buyers quietly absorbing every wave of selling, accumulating shares that retail participants are too impatient or too frightened to hold. The reverse applies with equal force when seeking short positions. In a declining market, the stock you select must demonstrate clear and consistent weakness, falling harder than the index on down days, rallying only feebly when the market attempts to recover. Such stocks are being actively distributed by professional interests, and the path of least resistance is unmistakably downward. If you examine a candidate and find it moving in rough alignment with the market, neither notably stronger nor weaker, the instruction is straightforward. Drop it. Move to the next candidate without hesitation or regret. When you finally locate a stock that passes this test with genuine clarity, one that leads the market upward and holds with quiet dignity during its reactions, something remarkable happens to your trading experience. Positions move in your favor more quickly, require less tolerance for drawdown, and reach their projected objectives with a smoothness that feels almost effortless. That smoothness is not coincidence. It is the natural result of trading in complete harmony with the force that moves all markets, institutional conviction, expressed through comparative strength, visible to every trader disciplined enough to look. There is a silent epidemic destroying the accounts of otherwise intelligent traders, and it has nothing to do with picking the wrong stocks or misreading the market's direction. These traders identify accumulation correctly. They confirm comparative strength. They wait patiently for the right moment to enter. Yet weeks later, they watch their positions stall inexplicably, churn sideways, and eventually reverse, never delivering the substantial move they anticipated. The entry was correct. The stock was correct. The market was correct. What was missing was something far more fundamental, a cause large enough to actually produce the effect they were expecting. Before committing a single dollar to any trade, no matter how compelling the chart structure appears, step back from the price action entirely. Resist the instinct to act on what the stock looks like it is doing right now. Instead, ask yourself the question that separates disciplined Wyckoff practitioners from every other technical trader. Has this stock spent sufficient time in its trading range, building a cause proportional to the price objective I am targeting? If you cannot measure that cause with reasonable precision, you are not trading. You are gambling with an attractive chart pattern as your justification. This principle flows directly from my law of cause and effect, one of the 3 foundational laws upon which this entire method rests. Every significant price movement that unfolds in the market is not spontaneous. It is the direct result of a preparation period, a trading range during which large institutional operators methodically accumulate or distribute shares. The longer and wider that trading range, the greater the cause being constructed, and consequently the greater the effect that will emerge when price finally breaks free. The instrument I developed for measuring this cause precisely is the point and figure chart. Unlike bar charts, which reveal the behavior of price over time, the point and figure chart compresses that behavior into a horizontal count. Boxes measured across the width of the trading range at a specific price level. Multiply those boxes by the box size and the reversal amount, and you arrive at a projected price target. In modern trading, this same methodology applies with full validity. Whether you are analyzing a technology stock trading at $300 or an index ETF, the horizontal count within the trading range tells you whether the cause is sufficient to justify pursuing the trade at all. A narrow trading range producing a small horizontal count projects a modest price target. A wide extended trading range, one that has spent months absorbing supply or exhausting demand, projects a target substantial enough to reward the risk taken. Wyckoff's ninth buying test demands that estimated upside profit potential be at least 3 times the risk if your stop-loss were triggered. Without measuring the cause through point and figure counts, satisfying that test becomes impossible. Once you develop the discipline to measure cause before entering any trade, the entire character of your trading transforms. You stop chasing stocks that have built insufficient foundations for meaningful moves. You concentrate your capital exclusively on those issues where the preparation has been thorough, the cause is measurable, and the projected effect is proportional to the risk being accepted. Positions begin moving toward their objectives with a purposefulness that feels entirely different from ordinary speculation. That feeling is the direct experience of trading in alignment with Wyckoff's law, cause and effect working precisely and powerfully in your favor. Consider the trader who has done everything correctly up to this point. He has read the general market and confirmed its direction. He has identified a stock demonstrating clear comparative strength. He has measured the cause within the trading range and confirmed that the projected price target justifies the risk. By every reasonable measure, this trade appears ready, and so he enters only to watch the stock immediately stall, reverse, and grind painfully against his position for weeks. The analysis was sound. The logic was impeccable. Yet the trade failed at the very first step. What this trader lacked was not better analysis. It was confirmation that the stock itself was genuinely prepared to move at that precise moment. No matter how favorable a trade appears across every dimension of your analysis, discipline yourself to pause at the threshold of entry. The market will not reward impatience, regardless of how correct your broader assessment may be. A stock can be accumulating correctly, showing comparative strength and carrying sufficient cause, and still require additional time before the line of least resistance has shifted decisively in the direction of your trade. One final layer of verification must be applied before capital is committed. That layer consists of 9 specific tests, each designed to confirm a different dimension of the stock's readiness. These 9 buying tests and their mirror image, the 9 selling tests, represent the most practical and actionable component of this entire method. They are not abstract concepts. They are observable, measurable conditions visible directly on bar charts and point and figure charts, applicable to any freely traded market operating in today's environment. For a stock being considered for a long position, the tests examine whether preliminary support, a selling climax, and a secondary test are visible, confirming that the downtrend has been genuinely halted by institutional buying. They verify that volume behavior has turned constructive, expanding on rallies and contracting on reactions, They confirm that the downward stride, the descending channel that governed the prior decline, has been decisively broken. Higher lows and higher highs must be forming, demonstrating that demand is progressively overwhelming supply. The stock must be showing measurable strength relative to the broader market index. A base must be forming on the point and figure chart. And critically, the estimated profit potential must be at least 3 times the risk represented by the initial stop-loss placement. In modern application, these tests translate directly to scanning tools, relative strength indicators, and volume analysis software, all of which make the process faster without diminishing its precision. A stock satisfying 6 or 7 tests warrants serious attention. One satisfying all 9 represents the highest probability trade the Wyckoff method can identify. When a stock passes all 9 tests with genuine clarity, the experience of entering that trade is categorically different from ordinary speculation. The position moves with immediate purpose. Drawdowns are shallow and brief. The stock behaves as though it already knows where it is going, because institutionally it does. That decisive, fluid price movement in your favor is the unmistakable signature of a trade entered not on hope or intuition, but on complete, systematic confirmation that the stock was genuinely, measurably, and irrefutably ready to move. Here is a scenario that has quietly devastated more well-prepared traders than any other single failure in this discipline. A trader completes his analysis with extraordinary thoroughness. The market's direction has been confirmed. The stock demonstrates undeniable comparative strength. The cause has been measured and is more than sufficient. All 9 buying tests have been satisfied with remarkable clarity. Everything points toward an imminent and powerful advance. He enters with full conviction and then watches with growing dread as his perfectly selected stock begins declining immediately after entry. Not because his stock analysis was wrong, not because his method failed him, but because he entered his individual position at precisely the moment the general market was turning downward against him. At the very threshold of entry, even after every prior step has been completed with full satisfaction, stop yourself one final time. Return your attention completely to the general market, not to your stock, not to your profit target, not to the cause you have measured so carefully, to the market itself. Ask with complete seriousness, is the general market, at this precise moment, confirming a turn in the direction of my intended trade? Is there evidence on the market index chart that the broader institutional campaign is aligning with my entry right now? If that confirmation is absent, no entry is warranted regardless of how perfect everything else appears. The mathematical reality behind this principle is one I observed consistently throughout my years of studying market behavior. 3/4 or more of all individual stocks move in harmony with the general market. This is not a tendency or a rough approximation. It is a persistent structural truth that governs price behavior across every market cycle. When the composite man is pressing the general market upward, the institutional momentum behind that campaign carries the overwhelming majority of individual stocks along with it. When that same force reverses, it overwhelms the individual merits of even the most carefully selected issue. In modern markets, this principle operates with even greater force than in my era. Index-linked algorithmic programs, ETF rebalancing mechanisms, and correlated institutional positioning mean that broad market turns now transmit to individual stocks with extraordinary speed and precision. The trader who enters an individual long position while the S&P 500 is rolling over into a distribution phase is not exercising independent judgment. He is simply absorbing the selling pressure that institutional operators are directing into the broader market. The specific Wyckoff signals to monitor on the market index are a change of character in price action, particularly wide spread-down bars on elevated volume after a sustained advance, combined with visible manifestations of the 3 laws across the index chart itself. When these signals appear on the index simultaneously with your stock completing its final test, the alignment is complete. When genuine market turn confirmation arrives, when the index itself demonstrates that institutional demand has reasserted control at precisely the moment your stock has completed every test of readiness, the resulting trade carries a quality that is immediately recognizable. Price advances from your entry with a smoothness and consistency that requires almost no tolerance for adverse movement. The general market current and your individual stock's internal strength combine into a single unified force, carrying your position forward with the full weight of institutional conviction behind it. That alignment, market stock, tests, and timing converging simultaneously represents the Wyckoff method operating at its highest and most profitable expression. In all my years of observing markets and studying the behavior of both successful operators and repeatedly devastated retail traders, one pattern of destruction appeared with heartbreaking consistency. A trader enters a well-researched position with genuine confidence. The first few days develop favorably. Then a sudden, sharp reaction strikes, the kind that appears without warning and moves with unsettling velocity. In that moment, rather than honoring a predetermined exit point, the trader makes a decision that will define his entire financial future. He tells himself the analysis is still correct. He tells himself the reaction is temporary. He holds and then holds further, while his loss compounds from manageable to catastrophic. The trade that was built on months of disciplined analysis is ultimately destroyed not by faulty methodology, but by the complete absence of one structural discipline at the moment it mattered most. Before celebrating the quality of your entry, before calculating your profit target, before congratulating yourself on the thoroughness of your preparation, establish with absolute precision where you are wrong. Define that price level completely, without compromise or flexibility, before a single share is purchased or sold short, not approximately, not as a mental note subject to revision when the market moves uncomfortably against you. As a standing order, placed in the market at the moment of entry, functioning independently of your emotions, your opinions, your hopes about what the stock should be doing. The stop-loss within the Wyckoff method is not a defensive afterthought, it is a structural component of the trade itself, as fundamental as the cause measurement or the 9 buying tests. Its placement is not arbitrary. For a long position established after a spring and successful test in an accumulation trading range, the logical stop resides below the low of that spring, the level at which the stock's behavior would conclusively invalidate the accumulation thesis. Should price return to that level on significant volume, the Composite man's campaign has either failed or the original analysis was incorrect. Either conclusion demands immediate exit without deliberation. In modern trading environments, this discipline carries additional dimensions that I could not have fully anticipated. Algorithmic stop hunting by institutional programs means that stop placement requires thoughtful consideration of the trading range structure, not mechanical percentage-based formulas that sophisticated operators can anticipate and exploit. The Wyckoff practitioner places stops at structurally significant levels determined by the specific events within the trading range, then trails those stops methodically as the position develops, always maintaining a buffer sufficient to survive normal reactions without premature ejection from a valid campaign. The trailing mechanism is equally important. As price advances through successive phases, the stop follows, locking in realized gains while allowing the position sufficient room to develop toward its full projected objective. When this discipline is applied consistently and without exception, something profound happens to the entire experience of trading. The crushing psychological weight of unlimited loss potential disappears completely. Each trade becomes a defined, business-like proposition, a specific risk accepted in pursuit of a specific, measured reward. Losses, when they occur, remain small enough to be recovered quickly. Winning positions are held with patience and confidence because the structural stop protects accumulated gains automatically. The market's inevitable volatility, which once produced anxiety and impulsive decisions, becomes entirely manageable. That transformation, from emotionally reactive speculation to calm, systematic capital deployment, is the ultimate gift that stop-loss discipline delivers to every trader disciplined enough to apply it without exception. Look honestly at where you stand today as a trader. Perhaps you have spent months or years entering positions that seemed logical only to watch them deteriorate without clear explanation. Perhaps you have experienced the particular agony of being correct about a stock's fundamental direction, yet still losing money on the trade. Perhaps you have watched your account oscillate between occasional wins and repeated, punishing losses that erase everything you worked so carefully to build. That experience, that persistent, exhausting cycle of 2 steps forward and 3 steps back, is not the result of insufficient intelligence or inadequate effort. It is the result of operating without a complete, systematic framework that addresses every dimension of a trade simultaneously. Before dismissing what has been presented across these 6 keynotes as too demanding, too structured, or too time-consuming for practical application in today's fast-moving markets, pause your skepticism entirely. The traders who struggle most consistently are not those who lack access to information. In the modern era, information is available to everyone in abundance. The traders who struggle are those who act on fragments of analysis rather than complete frameworks. They read one chart, enter one position, skip 3 essential steps, and wonder why results remain inconsistent. Completeness is not optional in this method. Every keynote presented here is a non-negotiable layer of the same unified structure. What has been constructed across these 6 keynotes is not a collection of independent techniques assembled loosely together. It is a single, integrated campaign methodology, each step building directly and deliberately upon the one preceding it. You begin by reading the general market, establishing the directional context within which all individual stock analysis must operate. You then select only those stocks demonstrating measurable comparative strength or weakness relative to that market, eliminating immediately the vast majority of candidates that carry insufficient institutional sponsorship. You measure the calls built within the trading range, ensuring that the projected price objective justifies the capital and risk being committed to the trade. You apply the 9 buying or selling tests, confirming that the stock's internal condition is genuinely prepared to move rather than merely appearing attractive on the surface. You time your entry with a confirmed turn in the general market index, ensuring that the full weight of institutional momentum is aligned behind your position at the precise moment of commitment, and you place your stop-loss immediately upon entry, a structural, non-negotiable boundary that protects your capital regardless of what subsequent price action may bring. In today's institutional landscape, where algorithmic programs execute thousands of trades per second and ETF flows transmit, market turns to individual stocks with unprecedented speed, this framework does not merely remain valid, it has become more essential than at any point in market history. The composite man of my era operated through telephone orders and ticker tape. Today's composite man operates through dark pools, high-frequency algorithms, and coordinated institutional campaigns of extraordinary sophistication. The retail trader who approaches this environment without a complete, systematic framework is not simply at a disadvantage, he is the predetermined source of liquidity that funds the profits of those who do. Master these 6 keynotes not as theoretical concepts, but as living disciplines applied consistently to every trade you consider, and the market will gradually reveal itself to you in an entirely different light. The confusion that once characterized your chart reading will be replaced by clarity. The anxiety that once accompanied your entries will be replaced by structured confidence. The losses that once felt random and unavoidable will become small, defined and recoverable. And the winning trades, those positions where market direction, comparative strength, sufficient cause, 9 confirmed tests, precise market timing, and disciplined stop placement all converge simultaneously, will advance with a power and consistency that makes the effort of mastering this method feel not merely worthwhile, but absolutely indispensable. That is the promise of the Wyckoff method, not easy profits, but informed, disciplined, and systematically repeatable success for every trader willing to honor its complete and uncompromising structure.